Well, good morning. Welcome back to the broadcast, Retirement Network. I'm Jeff Snyder. This is BRN Sunday for Sunday, December 19th, 2021. We've got another great show for you this week. I'll be joined by members of the media, academia, and financial services as we analyze all the news in retirement markets, technology, personal finance, so much more. So sit back, relax, enjoy this episode of BRN Sunday. Well, let's kick the show off with a look at what's happening on Capitol Hill, or maybe for this segment, what has happened this year on Capitol Hill and in regulatory space and litigation space. And joining us on the line, they're known as the Legal Eagles. That's actually a reference to a great movie, but we also know them as David Levine, Kevin Walsh. Both are principals with Groom Law Group, an employee benefits law firm based in Washington, D.C. Gentlemen, great to see you. Thanks so much for joining us on the program this morning.
Thank you so much for having us, Jeff. And we're excited to kick off our series of year-end retrospectives today. It's kind of like what everybody does. You've got the recap shows for the last couple weeks of the year. So let's get this started.
Yeah, Kevin, you want to kick us down the can down the road?
Yeah, sure. I'd love to take the first glance back at 2021 as we get ready to roll into 2022. And I think this week we're going to focus on what happened in the past year of litigation. And to me, there's one big case that's kind of was the focal point of last year, and it was fee litigation involving Northwestern University. And what made it a big deal was that in December, the Supreme Court heard arguments about it. And ultimately, what the Supreme Court has been asked to resolve is, essentially how much diligence does a prudent fiduciary have to do in terms of seeing if there are less expensive options on the marketplace in order to avoid being held responsible for not having picked that lower priced option. And I don't want to talk too much about it because I know that David wants to highlight other things in the year behind. But to me, anytime you see an ERISA case in the Supreme Court, it's exciting. And I think we can look forward to next year when it gets decided. And maybe we'll talk about that in future weeks. So David, for me, the exciting thing is that fee litigation rumbles on, but there is an opportunity for clear guidance in the not too distant future.
Kevin, I give it a more likely than not that there's a reasonable chance that there might be possibly clear guidance on that case. That's my takeaway. But if you ask me what's on my list this week, as I look back on the year that was 2021 in litigation, I think it's the evolution of litigation claims. The number of law firms bringing lawsuits around benefit plans, and notice I said benefit plans, is not. There have been attempts by some of the same firms in health and welfare that have, some of them, fallen flat. But at the same time, there have been a number of attempts to sort of expand beyond it's just about the basic fees on funds and record keeping. It's a trend that's been going on for a while, but this year it really kept going from early decisions on cases involving the use of data and cross-selling to cybersecurity breach types of claims, to claims not only about fees on investment funds, about fees about different services within a plan and the role of each party within a plan. I think this really showed a year where especially some of the leading plaintiffs firms branched out, and leading being the ones who are most innovative in their claims. I think where does this land to be determined? It certainly sent a number of waves through the industry because it does take a village to go back to politics of 2016 or 15 to use Hillary Clinton book. But it does really take a village to run a retirement plan. It's very hard. And whereas a lot of the earlier fee cases were very much, you paid too much, they've really started delving into, well, how does this work? How does this operate? For us on the defense side, I think many of us say, people have worked hard to structure and provide robust services, and there's a lot of diligence that goes into this process. But at the same time, the plaintiffs have come up with a bunch of new theories, and I think that will continue to drive litigation into 2022. Kevin, what do you think?
I think the things you highlighted are spot on. I mean, to me, the fees are going to continue to be a focus. But with increasing frequency in the past year, we've seen, variations on, data use or data, um, hacking claims. And so I think those trends, they've continued to grow. So I would expect them to continue to grow in the new year. But I think everything you said, David, are kind of the key points. And I think with that, we should probably, let the listeners get back to their Christmas cheer, their holiday cheer, and let Jeff get to his next segment.
Yeah, well,
That
guys,
sounds great.
I really thank you a lot for this look back and this evolution. It is very interesting. It'll be a fun, I guess, quasi-fun trend to watch, and we'll all be looking ahead at what the Supreme Court decides later in 2022. Gentlemen, want to wish you a great rest of your weekend, a great holiday, and we look forward to having you back again next week very soon.
Thanks, Jeff. Thanks for having us on. Thanks,
Bye,
Jeff.
guys. Bye-bye.
Everybody.
Welcome back, and now time to talk, I should say. Well, I can't even get it out this morning. Time to talk a little technology, consumer products, all the above. Joining us on the line, he is the managing editor for The Street, Daniel Klein. Dan, thanks so much for joining us on the program this morning.
Good morning, Jeff. I'd say happy Hanukkah, but I think that's over. Merry Christmas.
Merry Christmas, Happy New Year, all that kind of good stuff. Thank you, Dan. And I'm a little tongue-tied today, but can certainly get your name out, which is good. Dan, let's talk about 62% of older Americans, this is a stat recently, have used telehealth during the pandemic, but there are still concerns around that. And I know you wanted to talk about this.
Well, people talk about the new normal. And I'm not a fan of that because I think the reality is post-pandemic, most things are going to go back to regular. Like we're not going to eat every meal hunkered in our house that, after not touching the Uber Eats driver. I mean, you're not supposed to touch your Uber Eats driver, but you can't, wearing a mask and not doing a handoff of your food. That's not going to be the new normal. But telehealth is. So here's the reality. It's not fun to go to the doctor. And a lot of times when you go to the doctor, it's not because you need the doctor to check you out. Mm-hmm. It's because you either need the doctor to look at something or you know what's wrong and it's not that big a deal and you want a prescription. I'll give an example. My son had a telehealth appointment because he was having allergies when we were in a different part of Florida. And once a year, he gets really bad seasonal allergies. It happens every year. So we put him on the video call with the telehealth. They looked at him and went, yep, allergies, called in a prescription, and I went and picked it up. A lot of older Americans are taking advantage of this, and this is an age group that's not as open to technology, that's not as experienced with technology. That's certainly not universal. We both know lots of older people who are very good with technology, but they're embracing the convenience of this. And look, a lot of people have done that because it's safer during the pandemic, but post-pandemic, I think we're going to see like even a lot of places like the part of our annual physical that doesn't involve being examined. I think there's a really good chance that happens via telehealth, and your appointments might become like right now they're sort of split in half. You go for lab work and then you go to the doctor, usually in the opposite order. Now it might be you do a telehealth appointment where you get most of the questions out of the way, then you go for lab work, and then maybe not even every year you go in and get looked at and prodded and whatever else happens depending on your health situation. So I do think we've seen a pretty seismic shift in healthcare, and it's like the first one I can ever remember that's pro-consumer.
Yeah, Dan, I got to tell you, when you go for your annual physical, the doctor, they spend like 15 minutes with you, a half an hour maybe at the most. The most of the time, at least, I'm going to be 50 this year, most of the time is spent in the lab getting blood work. I mean, there's not a lot of, they might check your reflexes and they might check your blood pressure, but most of it's like, okay, how you feel, have you had any aches or bumps and things like that. So a lot of that, in my mind, can be done as you're suggesting, through telehealth like we've been doing.
Yeah, and I think that's absolutely going to happen. I also think you might get like a certain type of doctor that just does that, and then you go to a doctor who just likes doing the in-person part. You may have a doctor who's your doctor that may be someone who you only know digitally that's directing your medical care and sending you to places to get tests. Look, you don't know the guy at like Quest Labs or wherever it is you go to get your blood work done. We all have sort of done this sort of split up healthcare, and I think that's going to be the new normal, but in a way that's actually like pretty positive for consumers.
Dan, let's talk about some of the concerns. Top of my mind, privacy. What concerns do you have about this? Is it that there's less understanding? There's only 62% that are favorable about this, and what about the other 38%? In your mind, what sticks out as things that we need to look out for? Maybe not be concerned about, but look out for.
So it's too easy, and I'll give an example. I was very briefly on a prescription, and I accidentally filed the prescription at a pretty far away CVS.
Mm-hmm.
And it was really tricky. I couldn't figure out how to get CVS to move it. So I used a telehealth appointment to without seeing a doctor or talking to a doctor, just get the prescription filled again because it was a generic drug. It wasn't expensive at the CVS closest to me, which actually flagged the CVS system, and they asked some questions. But it wasn't when I explained it wasn't too big a deal. That was too easy. You shouldn't be able to get, and again, these weren't hardcore drugs, but you shouldn't be able to get a prescription for a prescription drug just by filling out a form. And there's a little bit that's too easy with it. So we do need to tighten those things up. You've all seen those, those commercials for, whether it's birth control or various male problem drugs where you can go to a website and fill out a form and they send you. If something's going to be a prescription, it should involve a doctor, at least a consultation with a doctor. And if it doesn't require that, then maybe it doesn't need to be a prescription drug, or maybe we need to have a different class of prescription drugs that just require you send an email. So I think some of this it can be a problem for someone like me who doesn't love going to the doctor and will take the easy route out and be like, oh, I saw a doctor last year. We talked for 4 minutes on Skype. That's not an ideal scenario. So that part does scare me a little bit. But I do think we'll see health insurance both encouraging the use of telemedicine for when you have strep throat, and maybe you go to a lab and get a culture, but you talk to the doctor and you don't go into the office and infect other people. But I think when you feel chest pain, you're probably going to be encouraged to go to the doctor, and maybe there'll be less of a wait when you get there because more things will be handled via telemedicine.
Yeah, I'm interested to see how skin conditions, dermatological exams are handled, and then are we eventually going to have laptop cameras or cameras that have the ability to really zoom, Dan? Because when the doctor, if you're going to a dermatologist, say you have a skin eczema or something on your skin, they have to look at it. They have to, or maybe you take a picture of it.
So here's the thing. It's not ideal, and it does work for certain things. So I had a small infection hangnail about, a year ago, and I took a picture of it and had to send it to my doctor before the appointment, and it was very clear what it was, and the doctor wrote me an antibiotic, and it wasn't a particularly big deal. But there's some risk there. That's a doctor that I've never seen before. It was just someone that my health insurance connected me to. And I know I'm allergic to penicillin, and I was able to remember that and tell it to him. But he has no records of me. That wasn't – so what if he had prescribed something I was allergic to? Now, fortunately, I'm not deathly allergic. I turn into a Dr. Seuss character. I get purple and spotted and and it's not great. But I knew that, so I passed it on. But there is a little bit of danger when your records aren't moving with you, when you're traveling, when you're, when it's very easy. But yeah, technology will make all of this better. But at some point, look, you're probably going to step into your home scanner and it's going to do a full MRI and body scan. But that's way in the future. Every year cameras get a little bit better and a little bit more will be viable. But I think I told you, I had I couldn't talk. And I sent in a picture of my throat, and it wasn't that helpful. That was something I should have done in person. The reality was, at that time, it was the height of the pandemic, and doctors weren't seeing you for a little touch of the laryngitis.
Yeah. All right, Dan, let's switch gears. Let's talk about something kind of, I don't know, it's kind of healthcare related, I think. But there are more and more retail restaurants that are creating, not having in-restaurant dining rooms, and this is starting to see a trend. I think Chipotle is one, Starbucks is another. What can you tell us here?
Yeah, it's problematic. So Starbucks does it really well. And Starbucks, Starbucks Mobile and Order and Pay, you can fully customize, you can do whatever you want. I won't say I've never had a problem with it, because maybe once in the 5,000 times I've used it, I've had it not connect, or I know I personally have accidentally ordered at the wrong store, which they make fun of me at the Starbucks I go to for. But Starbucks has it down, and Starbucks does it in Manhattan, where they're creating stores that you know where you're walking, you know when you get off the subway, you know when to order. The order flow is very logical, and they're almost always near a store that has a traditional dining room. So if you want that traditional experience, it's it's Manhattan. It's within a block or two. I once searched Starbucks within a mile of where I was in Manhattan, and there were 82 of them. So it's not, and that's not a made up number. That was real at the time. But Chipotle is doing the same thing, and here's the problem. Chipotle has what they call the Chipotle lane, which looks like a drive-through. But when you go through a traditional drive-through, you get to the window and you order. Well, you can't do that at the Chipotle lane. You have to use the app. And Starbucks doesn't make you do that. You can walk into the Starbucks and place an order. That may not be how most of their orders. In fact, even in a regular Starbucks, it's slightly more of the orders are digital than are traditional. But Chipotle, the few times I've used the Chipotle lane, it's kind of a mess. It takes a long time. Every bag looks the same. They don't have a great system. So I understand where Chipotle is going, but I think you have to get your technology down. You have to figure out your system before you start offering stores that don't have a place to sit and no way to order because everything is automated. So I'm bullish on the future, but I kind of think not every company is ready for this future.
Dan, is this a function of the pandemic and people are just saying people don't want to eat in? I mean, like you mentioned New York City and having 82 Starbucks at the time, probably a lot more, probably doubled that now. But look, what's happening in New York and other places where you can't can't have public sitting down of, eating there in public. I mean, is this a function of that, or is this about getting more efficient and lowering overhead and human capital?
So I think some of it's geography based. Like they're going to put these, like Starbucks does, in places where like the logical pattern, like the Starbucks might go near like a bunch of office buildings when their order flow is like people walking into work. So I don't think the pandemic has really changed other than the obvious change of like there were times we couldn't sit in a dining room and there are sometimes fears about doing that. But I don't think it changed our willingness to sit in a dining room. I think what it did change is our patterns. Because we're not going to work, we might be more willing to get a cup of coffee and sit at a table, or less willing to do it and just wait in a drive-through. It's also very difficult right now, and I very much sympathize with Starbucks on this. I can't figure out when they're busy, so I'm sure they can't figure out when they're busy because it varies. It used to be go to Starbucks 8 to 9 and it was crazy crowded. Now it's like go to Starbucks at 11 and it might be crazy crowded because that's when the work at home people have decided it's, coffee break time. So there's a lot of technology that's going to have to sort out, this sort of new reality of even as people go back to work, I don't think most people are going back to work 5 days a week unless they have a job that it really makes sense to be in person. So that's going to change things for your Starbucks and your Chipotles. A Chipotle that was built around, oh, hey, we're near a bunch of offices and people will come here for lunch. Well, that Chipotle may have to get into more delivery or, we see this every couple of years. Starbucks closes 400 or 500 stores and it's because of geography shifts. It's because maybe the office building next to the store closed and became a community center that doesn't draw the same crowd. Oh, that's a plot of like an 80s rap movie. But you know what I'm saying. Well, it's usually the reverse. It's usually they want to turn the community center into an evil office building. But what we're seeing is we don't exactly know what reality looks like. So what I like about what Chipotle is doing is they're testing all these boundaries. They're trying to figure out, okay, if we're in a market where everyone just wants to like order ahead and pick it up, how do we do that? And I don't think we're going to see thousands of Chipotles that don't have dining rooms. But I do think we're going to see this format used very strategically where it makes sense to do it.
Yeah. Well, Dan, a great reference to Break Into Electric Boogaloo. Shout out to Turbo and Ozone. Dan Klein, always great talking with you. Great stories this week, great analysis. Look forward to having you back on the program again next week, my friend. Enjoy your holiday week.
I saw it in the theaters. I will talk to you next week.
See you, buddy. Bye. Welcome back. Now we're going to finish up the show with a look at what happened this week with markets. A lot of things going on, and here to break it down, he is the lead anchor for the TD Ameritrade Network. He's also the host of Morning Trade Live and Markets on the Close. We're talking about Oliver Rennick. Oliver, thanks so much for joining us on the program this morning.
Hey, Jeff. Thank you. Appreciate it.
and happy holidays to you and your family.
Likewise.
Thank you so much, Oliver. It's always great spending a few minutes with you every once in a while to break down and things for our audience. Let's talk about some news out of the Federal Reserve this week. They kind of, I think, kind of sped things up and set the stage for earlier, faster interest rates hikes as inflation source.
That's correct. And for the most part, that was something that the market had been anticipating, had been preparing, something that most people started to become alert to within the last month and a half after Powell ditched the transitory language and started to hint that this was coming. But there were signs that this was far, far longer in the making. It's been a real centerpiece of our coverage on the network really since the summer, which it became obvious that the bond, well, maybe not obvious, but it became a compelling explanation for why markets were doing what they were doing, namely the yield curve collapsing that began in the late spring and then the breakout in the dollar that followed in the summer. Both of these, in my mind and in our coverage, pointed towards a tighter policy path coming from the Fed. Mm-hmm. But a lot of people missed that move, frankly. And the real puzzling question for investors for some time now has been what's happening in bonds and the yield curve getting really crunched, seemingly sending a cautionary message about the economy. A lot of it coming from the front end of bond yields moving higher in anticipation of higher interest rates, but then the long-term bond yields moving lower and signaling risk to the economy. So catch is a lot of people misinterpreted what was going on in bonds for a long time. When yields were going lower in the summer, they thought that that was happening because interest rates were going to stay low and the Fed would remain dovish because that has been the cause for low interest rates for a very long time. But in fact, somewhere along the line, and actually it was specifically in April, we had a lot of really good economic data. And from then on, the yield curve started compressing. And the reason why that began in the spring with really good economic data is because it was at that point that the market realized inflation was going to be sticky enough and it would cause the Fed to abandon their average inflation targeting. And so that's what happened this week was formally, even though people recently had been guessing and speculating about what the Fed would do, and even though bonds had been suggesting this and the dollar for months, this was the literal confirmation word from the horse's mouth on that being the plan. So the question now for investors is, was the market dynamics preceding this week's FOMC enough to price in the interest rate hikes for next year? In other words, is the market adequately prepared now? Did it adequately prepare for this abrupt regime and tone shift from the Fed? Or are there still adjustments that need to be made that have yet to be made? And that is why the volatility in the market is very fascinating and I think very important. I think this is the moment for bears if they are going to take control of the market. It is the structural framework that I've been laying out for months on why investors should be very cautious. And so now we find out what type of impact this will have. And as we speak, it's basically a draw. We've had one big up day, one big down day, and markets are battling into the weekend.
Oliver, when you look at what's happening on the Omicron front, the COVID front, taking into account this recent announcement or verbiage from the Federal Reserve Chairman Jay Powell, how does Omicron factor into all this? Does it factor? I mean, we know that I think it's highly contagious, but maybe symptomatically not the same as the Delta variant, but we're hearing a lot about it. Does that play into any of the market gyrations that you're following?
It's very hard to figure out right now, but the short answer is yes, it's a contributing factor, but it is not compelling as the best explanation for why we're seeing what we're seeing. The market is very much aligned with interest rate driven risk right now, and specifically tech risk as well around earnings. So there are reasons to believe that COVID fears into next year are lingering and having an impact. Certainly, it could be helping keep the market under pressure, risk assets under pressure, but it doesn't really show up in a way that we would think, given the dynamics of the COVID regime in which the virus was the main fear. In those moments, you had really precise, acute selling and damage in reopening stocks. You're not really getting that right now. Those stocks are not doing well, but they're not doing particularly worse than anything else. What's really driving market volatility is high growth companies that were very successful during the COVID period that are now unwinding. And part of that related to the potential for valuations to compress in a rising interest rate environment next year, but also the fact that cloud companies on this latest earnings reports in the last 3 weeks, month of them reporting have just been really awful in terms of the market reaction to them. Selling and growth rates that look like they have peaked, and very .com style stuff where investors paid up for growth at any cost for a decade, and now the growth has achieved its destination of reaching more customers and a bigger market than these tech companies ever have, and now it looks like it's time to take profit. So that is distinct, different, and very important in the context of all of this.
Oliver, last question. S&P 500, I think, reached all-time highs over 50 times this year. Generally speaking, past performance is not indicative of future results. I just want to caveat that. But when typically when that happens, you may have a bit of a correction or a downturn in the year following. But without getting you to predict what's going to happen, because I wouldn't put you in that position, what are things that we need to – well, I don't think it's fair. I wouldn't want to be in that position. What do you think that investors should be paying very close attention to as we close out the year and at least look into the Q1 of 2022?
I mean, a lot of people will think I'm being overzealous or overdramatic in phrasing it this way, but I do believe that whichever way the market goes in the next week or so is going to be hugely indicative of what comes next. After a decade plus and then a hyper stimulative period during COVID, we are now, for the first time in basically a decade, entering an environment in which a Federal Reserve has told us their baseline now is to combat inflation and to be ready to tighten things up. Now, they're going to keep rates very low relative to inflation on a historical basis, but history is not really a great guiding light here, because we've never come off the zero bound of interest rates with the type of energy we are right now. We never really have. So for the first time ever, basically, since I even started covering markets, the concept of the Fed put is totally in jeopardy. The idea that there will always be a buyer there and that they will inject more and more, that is reversing now. And without any fiscal stimulus clarity from the White House, the market is basically in a liquidity kind of vacuum at this moment. And one could argue actually a bit of a liquidity drain. So if there is any bearish pressure, it's going to happen very soon. This is the opening. And if we start to take out technical levels in the small caps, I think that'll be the biggest sign that there is more downside coming. The small caps are basically technically looking at the chart on the precipice of a very big decline if the Russell 2000 slips past its year-long support. So that's really what I'm watching. If it does bounce and break out, then I think bears have really nothing for the next several months.
Well, I guess, as we always say, time will tell, but people can always check out the TD Ameritrade Network, where Oliver is a lead host along with his colleagues. Oliver, I want to thank you so much for your great coverage this year, just for TDA, but also helping us out on the Broadcast Retirement Network, and wishing you a very great holiday season with you and your family.
Absolutely. Thanks, Jeff. I appreciate it.
Take care, buddy. Bye-bye.
Have a good one. Bye.
That wraps up this episode of BRN Sunday. Have a topic of interest, someone you think we should talk to, then drop us a line. And don't forget, for all the information in lifestyle, wellness, finance, tech, so much more, check out our daily edition of our daily newsletter, The Morning Pulse. Want to search our archives or check out our latest content? Then visit our website and, of course, our streaming partners, Amazon, Roku, and over 100 more. We're back again tomorrow, this time for BRN AM. We'll have a very special guest discussing a very important topic or topics. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.